Today, Operation Anti-Spruik. Hello again, it's Martin North from Digital Finance Analytics, where I this post covering finance and problem news with a distinctively Australian flavour. Well, we've been discussing in recent times the change in momentum in the property market, thanks partly to the expectation of future interest rates and also, of course, rising prices at a time when households have bigger mortgages and are more highly leveraged. But of course, that doesn't stop many people out there in property land still saying, no, prices are fine, everything's good, and continuing to spruik until you drop. But what I want to do today is just take you through some further information which may act as an antidote to all that spruiking. And it's interesting that the focus of attention, certainly in some of my comments on my YouTube channel, relates to Queensland. So we're specifically going to look at property in and around Queensland. But before I do that, let me just remind you that when we talk about our analysis, it's being based very much on our research. And we use our core market model to look at what's going on. The core market model is driven by our surveys, they're rolling continually, and also our other modelling. And that allows us to get a very good feel for what is actually going on in and around the market. And it's worth just noting that we take account of things like mortgage stress, the price trajectory, the history, and also the expectations, the buying and selling intentions, migration statistics, and also the latest economics, including CPI, wages and employment. And we bung all of that into our core market model, run across our scenarios, and that allows us to form some opinions about what may be happening down at a postcode level. Now, that's a pretty important piece of analysis to do now, because it is very important that we don't get caught into thinking that property is somehow one single market nationally. It's very different in different places. It behaves differently whether looking at houses or units, and indeed different price zones as well. This is a very important thing to understand because, of course, people talk about property prices going up or property prices coming down without understanding some of these important differences. And if you actually want to get into detail about a particular suburb, then you can talk to me via my one-on-one service. The one-to-one service is essentially an individual confidential discussion. I can't give financial advice, of course, but I can discuss my data down at a given postcode level and look at some of the underlying trends. And I can look at things like stress, the home price trend view, and also look at the forward projections based on my modelling. It's just estimates, of course. It might be completely wrong. You can then, if you want, book a time for an hour. It can be either via Zoom or phone. And there's a fee attached to it simply because there's a lot of research to be done to be able to actually pull that information out down at an individual level. I do also have quite a lot of people booked at the moment. So we're looking at typically 3 to 5 weeks lag between people saying they'd like to connect with me and being able to have that conversation. But if you are interested, go across to my blog. You can get more information about my one-to-one service. Now, before I get into the detail, it's worth just highlighting that the final clearance rates, according to CoreLogic, were below 60% again. And what they're really highlighting is that this is one of the lowest clearance rates across most of the capital cities. Now, of course, it is a long weekend, but nevertheless, I think these trends are pretty important because it does highlight the downward trend at the moment in terms of clearance rates. But of course, the number of auctions also are potentially lower. But it's also worth reflecting on this. This is from the Illawarra Mercury, and it was just highlighting the fact that food prices have really shot up dramatically. In fact, in their recent analysis in the Illawarra, looking at a typical basket of normal foods, so things like milk, bread, eggs, apples, broccoli, bananas, chicken breasts, pasta, rice, strawberries, and cheese, well, an Aldi, that's gone up by 20.2%, compared with Coles up 24%, Woolworths up 20.3%, and one of the local markets up 17.4%. And that's just over the quarter. So this is a big deal, and this is one of the reasons why mortgage stress is so significant, of course, because we look at it holistically. We don't just look at the mortgage repayment, because when we analyse mortgage stress, we look at it in the round. We look at household flows from all sources, money in, money out, and that includes, of course, the cost of food. So if food prices are rising significantly, that has a very significant dampening effect on household budgets. And the Mercury in this article compared the price of a shopping basket of essentials at Coles, Woolworths, Aldi and Fairy Meadows Leisure Coast Market to see how much a shop actually costs and which chain came where. The conclusion is Coles, black mark. And it's worth looking at this. This is the Grattan Institute analysis of households in Australia with a mortgage, and highlighting that there will be a very sharp rise in mortgage interest repayments if interest rates rose. Now, of course, the fact of the matter is that this is only looking at the interest costs. But we also have to think about the principal costs as well. Unfortunately, a lot of the analysis that's done, and it's often from the Spruikers, only looks at the interest element in the mortgage repayment. And of course, when rates are low, mortgage repayments are low. But you have to also consider repaying the capital over time as well. Now, there's a couple of observations there. Firstly, is the average mortgage is a lot longer than it used to be, quite often 30 years, or some cases 35 years, compared with 20 or 25 years, which means that the principal repayments get paid over a longer period. But it also means you pay a lot more interest because, of course, the loan is there for a lot longer. The banks love that, but not necessarily should owners love that. And the other point is that when they only talk about the interest repayments, they're giving a very artificial view. If you factor in the larger mortgages and therefore the bigger principal and therefore the bigger principal repayments, that means that there's more to pay. And you've really got to look at this holistically. I do that in my mortgage stress. So I look at both the interest and the principal repayment. And just to recognise again what's going on, mortgage stress has never been higher. 43% of households in mortgage stress, defined in cash flow terms, money in, money out. So how much money is coming into the household, how much money is going out from the household, including on the mortgage repayment. And it's also worth highlighting that the rental stress has gone through the roof for the same reasons. Expenses are high, rents have gone up. And the household debt, of course, is also extremely high in Australia. It's very, very significant. We have some of the most significantly indebted households in the world. Something, again, that so many of the Spruikers seem to forget. Like, it's a magic money tree. Interest rates are so low, you can get big mortgages, so buy. Well, yeah, maybe not. Maybe now's the time to think about it a bit differently. Now, what I try to do in my surveys and in my analysis is to think about how the scenarios may play out from here, because I quite often get questions about what do I think house prices are going to do? And that is a good question, but it's a bad question because, frankly, an average is very, very misleading. You've got to look at more granular data, as I'll show you shortly. Anyway, the baseline RBA view, it seems to me, is that we're going to have in the next couple of years a cash rate of around 2.5%. The unemployment rate will still be pretty low. The mortgage rates will be at around 5.5 to maybe 6%. I think mortgage stress at that scenario will probably be quite high. Losses will be manageable, but there's going to be some falls in home prices. And the unnatural acts, of course, well, you end the QE and you put rate rises there. That's probably a 10% probability. Then I've got three scenarios. A best case scenario where the rates come up but then come back. That will have had a more significant lift in unemployment. Mortgage rates won't be quite as high, but the mortgage stress will be higher. The losses will be higher. And in that scenario, actually, there's still a path to some home price rises, but also potentially significant falls. And I wouldn't be surprised in that scenario to see more incentives, more first-time buyer teasers, and even perhaps cheap funding to the banks to try and get them to lend some more. I give that a 50% weighting. Then there's a longer-term crunch where effectively they take rates up but then have to bring them down a lot further. And eventually we could even be close to negative rates if that scenario plays out. Unemployment will be higher. Mortgage rate will be lower because of the fact the economy is grinding to a halt. Mortgage stress is still pretty high. The bank losses are up, and home prices will fall more significantly. And there will be more quantitative easing. There'll be more fiscal stimulus, and there'll be more bias towards negative interest rates. And I give that a 25% probability. And then the worst case scenario is that we might get more significant economic downdrafts from China, from Europe, and beyond. There is also a probability that rates will go into negative territory, unemployment would rise, the mortgage rate will be a lot lower, probably lower than we've ever seen before. Mortgage stress would be higher, the bank losses would be higher, and prices would fall. And in the worst case scenario, they could drop 30 to 45%. And in that situation, you could perhaps expect to see bail-in and bail-out and quantitative easing. I give that a 15% probability. So in fact, parking the RBA baseline, you can see we have 3 different scenarios, and those flow through into my modelling. And here's an example, just to illustrate how that works. This is actually West Gosford in the Central Coast. And the modelling that we do from our models pulls out the mortgage stress, the rental stress, and also the price scenarios. And in fact, where you have the positive moves, it goes green. Where you have downside, there is just negative signs. And then I've got 3 scenarios here, the best, what I call the base case, and the worst case. And I have it for houses and units because they behave somewhat differently. So the best case would be a rise of about 3.6% over the next 3 years for houses, or 2.7% for units. The worst case would be a fall over 3 years of perhaps 39% for houses, or 28% for units. And I also have the investment data here, and that's quite interesting too. Gross investment returns on average 3.5% in the postcode, but net investment returns after all the interest rate payments and the other costs of managing investment property take those returns to 0.1%. And we also have some specifics here in terms of how many households are in the postcode, how many are borrowing, how many are renting, and how many are investing. So that's how the postcode tool works. And in fact, if you want information for every postcode in Australia that we analyse, that is available via our Patreon service. You can subscribe to that and get information for every postcode that we look at each month. So with that introduction, what I thought I would do is just look at Queensland. And here is just a little bit of a snapshot. 3 different properties, all with price reductions, quite significant price reductions actually. And this is a common thread that I'm seeing. So in some cases, we're seeing reductions of 20, 30,000, in some cases 100,000, or give or take a bit more. And thanks to Cookie Boy, by the way, for providing some of this information. So let's look at an example. So this is a property that was listed 170 days ago, the 23rd of December 2021. And it was on the market at 947,000 at the end of last year. It then was increased in asking listing price to 1.1 million back in early 2022. And now it's back down to 899,000 offers over. And if we look at that particular postcode, which is postcode 4209, a couple of observations. There is some mortgage stress, around 30% of households are in mortgage stress, but rental stress is much higher. That's because, of course, a lot of investors are trying to get rate rises through the system at the moment. And from a scenario perspective, if things go really well, there is still a growth path for property in this postcode, maybe cumulative 13% over 3 years for houses. The base case, though, is a reduction of about 11% over 3 years, which is what this middle line shows. And the worst case scenario could be a fall of close to 30% cumulative over 3 years, depending on the sensitivities that we've discussed earlier. So the point to make here of this one is an example of a significant reduction in asking price. Here's another one. So this one was listed 87 days ago, 16th of March, And when it was first on, it was 995,000, 969,000 later, and now it's 899,000 offers over. And this particular postcode 4213 is another interesting example where there is still upside. If things go really well, in my best case scenario, maybe over the next 3 years, a 22% rise in value. On the other hand, the base case is a small fall over 3 years. That's the middle line. Worst case scenario, down about 19.8% over 3 years. Here's another example, and this is postcode 4214. And there it was listed 59 days ago, 13th of April. The price originally was 1.2 million, then it dropped to 1.07 million, and now offers over 995 on the 17th of May, and now it's at 970. So a considerable reduction. And it's also worth reflecting, again, in my scenarios, the information would suggest that the best case scenario could still give a capital appreciation of about 15% over 3 years if everything went well. The base case is down about 9%. The worst case is down about 26% over the next 3 years. And here's another one. This one, again, is quite interesting insofar that it was listed about 50 days ago, 1.025 million on the 28th of April. Then it was dropped to 990,000 on the 27th of May. And now its interests above 950. And this is Coomera Waters. And the scenarios, again, well, a bit of upside, 13% over 3 years, maybe, if the best case scenario plays out. The base case, though, is a fall of about 10% or 11% over 3 years. The worst case is down to about 30% over 3 years for the house. So that just gives you a bit of a flavour of how these things will play out based on the economic outcomes. Here's another example. And this one is actually in Nerang, postcode 4211. And there offers over 1.39 million on the 12th of March. Now it's dropped to 1.15 million, offers over, so a small fall, maybe more ahead, who knows. And once again, it's worth noting that the best case scenario is a small rise in prices, 14% over 3 years. The base case is a fall of 9% over 3 years. The worst case is a 28% fall over 3 years. And here's one more. Original asking was 1.499, and that was on the 9th of May. Now it's at 1.349. And this one's at Burley Waters. Postcode is 4220. And the best case scenario would suggest a potential rise in value of about 16% over 3 years. The base case is a fall of about 8%. The worst case is a fall of 26.7% over the next 3 years. And it's worth highlighting that the gross investment return might be around 4.7%, but the net investment return's just 1.3%, which is not that flash. But by the way, still a lot better than many investment properties in New South Wales or Victoria. And here's another one. The original asking was 1.75 million on the 9th of April. Now it's at 1.49 million. That's in postcode 4221, which includes Palm Beach. And looking at the analysis, we see that there is a small amount of mortgage stress, much more rental stress. The investment return is 4.7% for gross returns, 1.3% for net investment returns. And the scenario suggests that best case may be a rise of 17% over 3 years. The base case, though, is a fall of 6%, and the worst case is a fall of 24.9% over 3 years. So you can pick your choice, really. And here's one that's quite interesting, listed 33 days ago, the 9th of May. Original was 1.799, offers over, and then it was dropped by 100,000. And now it's dropped to 1.499 million. That's in Burley Heads, postcode 4220. And it's worth highlighting here that the mortgage stress is sitting at around 32% of households, rental stress a lot higher. Scenarios are that this may be, in the best case scenario, up about 16% over the next 3 years. The base case, though, is a fall of 8%. The worst case is a fall of about 27%. And one other Queensland property, postcode 4218, Broadbeach, offers over 2.15 million on the 10th of May. Now it's showing it offers over 1.55. Now, that's a significant drop. Not sure what the history is there, but nevertheless, it does show that prices could potentially be on the way down. And it's worth highlighting also that this shows, from a scenario perspective, best case up 13% over 3 years. The base case is down 11% over 3 years. The worst case is down 29.9% over 3 years. So the point really to make here, and this is just a few examples, is you need to go granular, you need to look at the detail of particular properties to understand what's going on. But nevertheless, the scenarios that I'm looking at suggest that even those property areas in Queensland that ran very hot are cooling. And there are probably 3 reasons for this. The first is we know that interstate migration trends are changing. There was a lot of movement up to Queensland. Secondly, we know that some people who bought are being forced to sell, partly because of the higher costs, particularly of mortgages relative to rental. And the third is that there's actually quite a strong supply now coming on. If you look at the listings, they're up substantially. So those factors would suggest to me that we're going to see more falls in the around areas of Queensland. So don't believe the spruikers when they say that Queensland is hot, hot, hot. It may be hot in a few places, but it's getting a bit tepid, and it could go a lot cooler. And my caution is simply this, that you need to look at the specifics of property on the ground. You need to understand the dynamics, and that includes like how many other properties are listed, and also, of course, the local dynamics in terms of mortgage stress and rental stress. It all helps to get a much better feel for what's going on. So, as an attempt to try and answer some of those spruikers, I hope this information has been useful. And if you'd like more information about specific postcodes, you can always contact me. And if you want a one-to-one session, I'm very happy to oblige, just with a bit of a lag, simply because it's pretty busy just now. But the bottom line is this: property prices are on the turn, interest rates are rising, expect more falls ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.